All right, let's begin the show. And there are no risk-free investments. An investor, before deciding on the investment instrument, should analyze the risk involved in a particular investment instrument, but also keep in mind their risk appetite. So how is your risk appetite or your risk profiling change? How does it change, or how dependent it is as and when you grow in age, be it a 30-year-old risk profile, 40-year or a 50-year? What is the kind of risk that differs as per age groups? Let's understand all of this. I have Mrin Agarwal, a founder, director of Finsafe with me. Mrin, good evening. Welcome to the show. So usually, we discuss about what kind of financial portfolio one should be having at these particular ages. But then today we are just going to focus on the risk profiling of these kind of investor, because, as you grow in your life, in not only terms of age, but then, in terms of your income, your lifestyle gets better. A lot of thing around you in terms of your financial planning also keeps changing. Till a certain age you have financial responsibilities on you, and after a certain age it just goes away. You're done with it. You have achieved maximum goals. So when you are a person who has a financial portfolio, what kind of risk profiling should be done, and what kind of risk profiling changes as per age? So that's the main question and the topic for today. But then before that, let's just understand what exactly is investor risk profile. Mrin, let's start with that.
All right. So good evening, Kavita, and it's lovely to be here today. Now, every investor has a risk profile depending upon what is the sort of risk that they want to take. So you have conservative, you have moderate, you have aggressive. Broadly, these are the three categories. And someone who's aggressive means that, they want their money to grow and they're willing to take a lot of risk to get their money grow. Whereas someone who's conservative means that they don't want to take risk and they're really want a very stable sort of a return in their portfolio. So, these are typically the three different types of risk profiles. And then, of course, you can further bring it down to say, okay, moderately conservative or moderately aggressive as well. But yes, these are the three main ones, basically.
So, Mrin, let's talk as per age, okay? Let's consider an investor who's 30 years old. Their risk appetite, their risk profiling would differ from a 20-year-old and a 40-year-old. Ideally, how much risk can a 30-year-old investor take? 30 to 40, if that's a bracket, if I want to consider.
All right. So you see there are different types of risk. There's market risk, which is basically the markets could go up or down. There's, of course, credit risk, which is more there in bonds, which means that they could be a default. And then there are other risks, even biases are a risk, okay? So when we look at a 30-year-old, right, or somebody in their 30s, certainly they can take more risk because they have a lot of years ahead of them. It is the accumulation phase where one is basically starting to accumulate assets and has a long term to invest. And at this age group, most people would have children's education goals to fulfill. Maybe they've just started a family, and of course, so children's education is a goal. Of course, saving for retirement is a goal that everybody has at any age in their life. And of course, at this age, since you're young, you can actually take an aggressive stance and take risk. So by taking risk, we mean putting it into an instrument where there could be volatility, for example, equities, right? So again, now within equities, you have mid cap, small cap, large cap. And I would say that somebody who's in 30s today, I would say get aggressive, because honestly, if you look at the numbers, so for example, if I have 50,000 rupees to invest for the next 25 years, and I'm just putting it in a safe instrument, and I'm maybe, let's say, buying some insurance policies or something, earning a 5-6% return, versus putting it in equities, which number one, beat inflation, and secondly, grow well over a long period of time, you could actually have 2x more, right? And that's the reason why I say that it's really important you have time on your side. And it's really important that you take a good amount of risk, be an aggressive risk taker, which means that when you're saving for retirement, look at equities, look at the NPS active equity. Again, while we are talking about taking risk, the other risk that I would actually caution people in 30s is, this whole FOMO factor, because today there's a lot of FOMO that people have, that their friend or their colleague or somebody whom they know is making much more money and making it much faster than them in various get rich quick schemes, right? So take risk, but take it in the right instrument, which is equities. publicly traded, regulated, lot of information available. And I would say, you could even go up to like 70% equities at this stage of your life.
Let's break this down further in terms of market cap allocation. So, since they can go aggressive, you mean more exposure in mid cap, small cap, or it's better to be very well diversified even over there?
I think more exposure in mid cap and small cap.
All right. Let's move on to our next age group, which is 40 years old. Now, this is the age where you can see your financial goals almost getting done with. Maybe a lot of people might be still be having their home loan. Few years left for maybe pay off the child education loan, or maybe that particular goal is just coming up. How do you navigate the risk factor over here? Because you also have to start thinking about your retirement.
So actually, a lot really depends upon what you've done in your 30s, right? So if you've been aggressive, if you've been saving a lot from your take home and you've been investing aggressively, then you know what, you can actually afford to say that I'll start reducing my risk. But I can tell you that in most of the cases, people have a lot of catching up to do because they have not invested good amounts and they have also not invested aggressively, which means they have chosen safer instrument for a larger portion of their money, right? And so, if you have a lot of catching up to do, right? So I'll give you a small example. Let's say you have a 10-year-old child and you have 8 years to go for your child education goal. Now, for example, let's say you're looking at saving 50 lakh rupees for the higher education, which is 8 years down the line. At a 10% return, you need to be investing 55,000. I can tell you, Kavita, most people would not be even investing 25,000 rupees, right? So now when you're in the situation where you're saving a very small amount, you have two options. Either you increase the amount, which is not very easy to do because this is also the age where you have a lot of expenses, or you basically increase the risk, right? So I would still say that in 40s, you can maintain 50% into equities, and you should do it because today, given the value of the goals and the inflation on the goals, equity is the only instrument that's going to help you basically achieve it. Again, I would say that this is a phase where when people want to play catch up, they try to look at high yielding debt instruments, but anything that's giving you 10 to 15% return, high yielding instrument like P2P or NCDs also comes with a lot of default risk, right? So again, I would say that, you need to take the risk, but take it in something that's more manageable, because when you take credit risk, it also comes with concentration risk as well. And you're putting a lot of your capital at risk out there. So I would say go with a 50-50, especially if you have to catch up on your investments.
So, as you pointed out in the beginning only that, what will be your risk profile depends on what kind of investment you did in your 30s. What about someone who's just beginning this investment journey?
Oh, they have to go really aggressive because, again, the amount of money that you have to invest is going to be limited. And so the only option that you really have is to take that aggressive stance and long-term stance. So both of the things they have to take care of.
In terms of risk, what will be the biggest risk for a 40-year-old if starting to invest at this age?
The biggest risk is going to be that they may not be able to achieve their financial goals, and they might get into a lot of loans, which is what we do see these days, right? So people taking education loan, home loan, and everything. So most of your salary is just going towards EMIs, which means that it's further impacting your retirement goal.
What about those people, Mrin, who are in their mid-40s maybe and also have their goal coming up in a few years? Now, what kind of risk profiling and investment safety actions that they need to implement?
Well, let's say we quantify this few years as 5 years, then certainly you can take some exposure into a balance fund. But if it's less than that, like if it's less than 4 years, then of course you have to be in safer instruments. You have to be in debt funds or in fixed deposits. And you really don't have a choice, unfortunately, that's what it is. One of the things that I do tell people often is that as Indians, we do hold a lot of passive assets in terms of gold, in terms of real estate. And I do tell people that, if it really comes to that, you might really want to look at utilizing these passive assets, for some of these goals, if you have not been able to save enough for it, right? So, but yes, from a risk perspective, if you have 5 years, you can look at taking some equity exposure through a balance fund.
Next age group is 50. Now you have your retirement looking at you, and if at all you've not planned for it, then it's going to be very tough. What do you say?
Yeah, it's going to be really tough. You're going to have to be dependent on someone else. Unfortunately, some years back, there was a RBI household survey, which actually showed that people tend to increase their loans as they go towards retirement. And here we're talking about actually reducing risk. So certainly when you are in 50s, again, everything depends upon what you did in the last 20, 25 years. Did you save up enough? And if you have saved up enough, then you can actually take you can start reducing the risk allocation, and you can say that now I really just want to conserve my capital. So you can take that sort of an attitude as well. One of the things that I find a lot, Kavita, is that this is the age where people really get into, again, looking at instruments that are giving them a high return and a high fixed return. So again, one of the risks, so, one part is really about the risks that you take in equities, but even with the risk that you take on debt, right? And we really don't talk about risk on debt as much as we talk about risk on equities, right? But when you look at the risk that people take on debt today, I think it's really high. So you have people buying NCDs of, let's say, NCDs which are rated A and below. These come with default risk. They come with liquidity risk because it's not easy for you to take your money out. And number three, they come with a concentration risk because you're allocating a large part of your capital to it to get that return, right? And a lot of this happens because people become very loss averse, right? So again, risk is not like everybody only equates risk to investing in equities, but risk can be from your own actions, your biases, and certainly, of course, there's risk in investing in debt instruments as well.
Last age group, 60. What's the risk profiling for them?
Well, I would say that, you should still have maybe 25% in equities. I don't recommend doing 100% debt. And the reason that you still need to have 25% in equities is because, again, in more cases than not, you will have a shortfall in terms of your corpus, in terms of what you can spend and stuff like that. So having a little bit of money into equities is always helpful. And you could always follow a bucket strategy where you bucket your monies into three parts: things that you need in the next 2 to 3 years, and things that you don't need in the next 5 years certainly can get into more equity like investments.
All right, so this was a risk profiling that we tried helping our viewers with today. Thank you so much, Mrin, for being on the show and helping our viewers. Thanks. We move on and let's talk about the rise of Indian mutual fund investor. We had a special interaction with Anthony Heredia, CEO, Mahindra Manulife AMC, and AMFI Vice Chairman. Let's listen into this. Hello and welcome to this very special edition where I have a very special guest today with me, Anthony Heredia, CEO, Mahindra Manulife, and AMFI Vice Chairman. Hello and welcome, Anthony, to this very special interaction that we are going to have. And congratulations, first of all, for the new role as AMFI Vice Chairman. A lot needs to be discussed on this, but let me just ask a very simple and basic question. Looking at AMFI and the way AMFI is working, not only for the industry, but also for the investors, taking up this new role, how do you feel about it, and how do you think the role of AMFI is going to get enhanced? And in fact, talking about investor education, financial literacy, what all do you think that's been done and will be elaborated now going ahead?
So, yeah, thank you. So I think it's very early days. So let me just broadly say that AMFI has done a lot of work in the field of investor awareness and education in the last decade, but particularly in the last 4 or 5 years, right? I mean, the Mutual Fund Sahi Hai campaign, I think, has done wonders to how the retail investor perceives mutual funds, purely from a perspective of acceptance, trust, it becoming a far more acceptable form of investment. That's one bucket of it. The second is, I think we should never forget our distributor community. Eventually, to succeed in getting investors into mutual funds, you require reach, and supporting the distribution community is also something that's very, very important. And thirdly, there are a variety of issues that various firms need broad support, guidance, etc. And for us, I think it's just a continuation of the great work that so many people in Amphi have done over the last many, many years.
You also have an AMC and the responsibility to run that AMC. Let me also ask you, what's the kind of investor interest, investor trends, and maybe some pocket areas where you as an AMC is also focusing?
So we are a relatively late entrant, right? We started in 2016, but our journey so far has been, I would say, decent, and we've been fortunate. One of the things we've focused on is make sure we have the right set of people managing our funds. Because at the end of the day, I think that's the product. The investment performance that you're able to generate consistently for investors, that quality determines how well you are perceived or how well you are not perceived. And that's been one very clear focus area for us, which is, I think, by and large, held very decently. The second is, if you look at the brand we represent, we are a brand that tends to be recognized far more in Bharat, as one would call it, and one would hope, therefore, that our ability to get investors in smaller cities, etc., as the industry expands, is effectively a little more easier for us than the average asset manager. The third, which is I think the main part, is that at least personally, I am convinced that given the way the GDP will likely grow over the next decade, given the way investors will aspirationally look at products that create wealth, beat inflation, the runway for mutual funds as an industry or as a category, I think, is magnificent, right? And so the a lot of people ask me, so what are you going to do differently because you guys entered so late? And the answer is, you don't need to do things differently. You just need to do simple things well. So I would say that comment would underpin what we've done so far and will underpin what we are going to do over the next 5-10 years as well.
I know it's too early to ask you about your top 10 priorities as far as Amphi Vice Chairman is concerned, but then being an industry person, you also feel the pulse of investors, you also feel the pulse of investing trends and the kind of participation that's going on, or in fact is increasing in equity markets. What about focusing on B30, tier 2, tier 3, tier 4? These are the places we're writing new success stories as far as investment and investments via mutual funds are concerned. As an industry person, as an Amphi Vice Chairman, as a CEO of a fund house, how do you see this story unveiling further?
So let me put it in two parts. I obviously agree that B30 or smaller markets are going to see exponential growth. But if you look at the penetration of mutual funds today in aggregate, it means that potentially 6 out of 10 investors in Mumbai are still not investing in mutual funds the way they should, or Delhi or Calcutta or Chennai for that matter. So I think the goal should be, how many investors can we get into the fold? Today we have 4 crore unique investors. I would prefer to frame our ambition in terms of saying, how can 4 crores become 8 crores and how quickly can that happen? How can 8 become 15 and 30? As opposed to defining it as has been popular defined as, how will 40 lakh or 50 lakh crores become 100 lakh crores? How will B30 become 30 or 40%? I think if you just define your ambition in terms of how many people can I create wealth for, and the more number of people I can create wealth for, the greater good we are doing to society as a whole. That gives a very, very different perspective. And I don't think that ambition, therefore, means that only B30 is what you focus on. I think there is enough to be done in T30 as well.
All right, last question to you, and then we'll wrap up this discussion. What categories in your fund house do you think people are really investing much in?
So if you look at statistics, especially over the last 6 to 9 months, I would say a lot of that has been small and mid cap. Uh, I would say that our advice, especially in the last 3 or 4 months to investors, is don't fall in love with categories based too much on what is being discussed, what is past returns. Probably better thing to do is look at flexi cap, multi cap, stay diversified, use systematic investment plans, use systematic investing through transfer plans. That is really what we are trying to advocate. Although I will concede that a lot of the money, at least in the last 6 to 9 months, predominantly has come in small and mid cap. But my view, the next 1 year, I think we'll see a lot more money coming in multi-cap funds and flexi-cap funds on equity. And I am a very, very big believer in the concept of multi-asset funds. I think, especially for investors who are thinking long-term, retirement planning, stuff like that, I think multi-asset funds that have equity, fixed income, and gold become hugely relevant. And I would say that I think that will be the fastest growing category over the next 1 to 2 years.
All right. Thank you so much, Anthony, for being on the show today and talking to our viewers. Thank you.
Thank you so much.
All right, so that's a word coming in from Anthony Heredia, but then we move on because in tonight's episode of Leaders of Tomorrow, Season 11, Guwahati Springboard, we had Anurag Rudra, Assam Civil Services Assistant Commissioner, Kamrup Metropolitan District, Guwahati, and Officer on Special Duty, Guwahati Jal Board, highlighting Guwahati's culture as a strong driver of growth and development. We also had Supratik Roy, Client Success Partner, Startup Banking, IDFC First Bank, emphasizing booster current account, a unique feature of IDFC First Bank to benefit small businesses. And in the second segment, we had Mridu Muloybura, personal finance expert, Finvest Guru Financial Services, educating on gold as an investment. Listen in.
I think Assam, considering its location, considering our culture, considering our history, and considering our rich tradition, can actually leverage culture as a very strong driver of growth and a very strong driver of development. An industry that is non-invasive and sustainable will definitely help us gain bigger dividends for the future.
Typically, an MSME will not be having treasury managers. So what we came up with, we said we would become your treasury manager. We came up with a product called FD Booster Account, wherein typically we are saying we would offer you interest on your current account. Any amount over 2 lakhs would be swept into an FD and thereby giving you interest.
Gold and real estate have long been considered safe havens, right? Is that now a perception that you believe no longer applies? What might your take be?
Gold as an asset in a household are generally not valued and so not accounted.
Right.
And as a financial planner, when I talk of asset allocation, gold, basically should not be more than 5 to 15%.
All right, so for this exclusive conversation, tune in to Leaders of Tomorrow tonight at 10:30 p.m. on ET Now. Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and on the auspicious occasion of Navaratri, we at ET Now will make your portfolio shine brighter with top stock recommendations from Sanjeev Bhasin. Let's listen in to his top stock pick on day 5.
Navaratri, a time of celebration, devotion and new beginnings. But this Navaratri, we are adding a financial twist to the festivities. Each day of this auspicious Navaratri, we are going to make your investment portfolio shine brighter with a special stock pick. With decades of experience, Sanjeev Bhasin has been a guiding light for countless investors, and he is here to unveil his 9 top stock picks, a Navaratri gift of financial wisdom for all of us. Thank you so much, Mr. Bhasin, for joining us on ET Now on the special occasion of Navaratri. Day 5 of Navaratri, and we have Mr. Bhasin sharing his next top pick for our viewers.
So now my fifth pick is the biggest of them all, which has underperformed for some time, but it's the time to get into Reliance. You've just read about ADIA taking a 0.6% stake and valuing the company at close to 10 lakh crore. Some of parts, the other businesses, that is Jio retail, Jio the telecom arm, and the new energy business and other businesses, oil to chemical, cannot be at below 6 lakh crore. Fair value of Reliance is 20 lakh crore to 23 lakh crore. Buy Reliance with a 1 year perspective of 2750 to 2800, maybe more. At least that much is coming. And this is one large cap which is going to add to the momentum of the stock market. If indices have to go to new highs, which I'm very, very sure Reliance had to participate. And now with valuations at a very comfortable level, I think Reliance is set to lead the leaders and the index higher.
Thank you so much, Mr. Bhasin, for joining us today on ET Now and sharing your top pick for Navaratri with all of our viewers. And remember, viewers, 9 days, 9 gems, courtesies Mr. Sanjeev Bhasin. You cannot afford to miss this.
Alright, on that note, let's slip into a short break, but then post that we'll be talking to our viewers and sorting out their financial portfolio queries. Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and there are plethora of funds available in the market to invest your hard-earned money in, but how do you assess which is the right fund for you and for your portfolio? What are the criteria that one should look at to help you navigate through this maze? We have Ms. Mrin Mamaji, CFP, Moneyworks Financial Services. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. Hi, good evening, Ms. Mrin, and welcome to the show. And let's begin our Q&A. First viewer is Shawnee, and she sent her question via email. She says that she's been investing 10,000 in mutual funds via SIP, and the funds that she has in the portfolio are SBI Small Cap, UTI Nifty 50 Index, HDFC Flexi Cap. She wants to know if these funds are good enough to continue investing for next 15 years.
So basically, she's reviewed her portfolio and all the funds seem to be above par. So she's got SBI Small Cap, she's got UTI Nifty 50 Index and HDFC Flexi Cap. And the returns for 2 years have been on par as well as for 5 years and 10 years. If she continues investing at a cap of about 15%, she will be returning about 68 lakhs at the end of 15 years. So if that's a query, she can continue with all the 3 funds. They are performing well in their category and they are on par.
So the thing over here is for 15 years, you think she needs to plan better, and maybe we really don't have a lot of information. We don't know what is her goal for which she wants to accumulate, what kind of a corpus. But then to start off with, are these funds or this is an ideal portfolio?
You know, typically if this is the amount that you are saving and you are not going to need anything for the next 15 years. So otherwise you have to plan for shorter term goals or emergencies. So for an emergency purpose, it would be better to be parking some money, at least about 10% of your portfolio, into a category called equity savings, which is good for about 12 to 15 months. You should select the equity savings fund, which has about 15% of equity exposure and 85% in bonds, so that if you need the money in the shorter term, it will be available to you without volatility of 100% equity fund. For the medium-term goal, you can select a large and a mid-cap category or a flexi category, which would be your goals for, say, between 2 to 5 years. Hello.
Mrin, we heard you over there. Okay, let's move on to our next question. I think I have Anjali on the phone line with me. Okay, I don't have her, but then she says that she started her first job recently, and she wants to start investing 5,000 in mutual funds every month for next 10 years, and she wants to understand the funds that you might want to recommend.
That's Anjali, right?
Anjali, right.
Yeah. So Anjali, if you don't have any shorter term requirements and 5,000 rupees is what you're going to invest for the longer term that you've mentioned about 10 years. So in that case, you can select 2,500 rupee each in a multi-cap strategy and in a small cap strategy. The funds we've recommended are Nippon India Small Cap Fund and Mahindra Manulife Multi-Cap Fund. Now, again, I would like to put a disclaimer here and say, you are not going to need this 5,000 rupees SIP for the next 10 years. If you are, then you also have to plan a little more liquid category, which could be a balanced advantage category or an equity savings category, where you could put a small amount even in that option. So out of 5,000, maybe you can put, say, 1,000 rupees in a fund which you can, use in the shorter term also. If you are confident of not needing this amount for the next 10 years as you specified, then you can confidently go into 2,000 rupee, 2,500 rupee multi-cap and 2,500 rupee mid-cap strategy, Nippon India small cap and Mahindra Manulife multi-cap. So you can interchange the mid and the small fairly decently.
Interesting, Nisreen, people are thinking of starting their investment right from their first job and the first salary that they get. But it's also important for them to start aligning their goals. Maybe right now they might just want to look at it as wealth creation, but then how can you align your goals when starting so early?
So, when you're starting early, a small percentage of your investable surplus, you should also think a little long term and plan for retirement. So that's the guidance that I think that we need to also tell, because we don't have a 401k in our country like the Americans do. So this kind of planning for the longer term, planning for at least the next 25 to 30 years should be encouraged right from your first paycheck. So at least, 30% of your investable surplus should be towards your longer term goals. And 50 to 60% can be for the medium or short term goals. Because as Kavita rightly said, we don't know when we will need the money, even in the shorter time frame, and then you have a very dissatisfactory customer experience because the money is locked away for the longer term and it's not liquid when you need it. For that category, there's something called a dynamic asset allocation category, where we have, the equity savings funds, the balance advantage categories, and also even for the very, very short term, we have something called an arbitrage fund, or a money market or low duration fund, which is something that you can consider from 0 to 12 months. So that is the money which is an alternative to your savings account, where you can take it at will. For an arbitrage fund, you get the money back in 2 days. And for a money market fund, you can get back the money only in 1 day. So these are the little changes that you can make to your portfolio. Rather than leave it idle in a savings account, you can put it to work in an arbitrage fund or in a money market or a low duration fund, where you can expect a little alpha over your savings account. Okay, so that's the kind of investment that you can use for, say, 1 to 3 year bucket of priorities. For 3 to 5 years, you can use something called a large and mid cap fund, where the money is in 100% equity, but at the same time does not have the volatility of a small and mid cap portfolio. And what you're planning for your retirement should ideally be in a multi-cap or in a mid-cap portfolio, which you hopefully won't touch it at least for the next 10 to 15 years.
Right. Let's move on to our next question. And next question is from Ritika. Nisreen, she says that she wants to invest 2,000 per month for next 10 years with the aim of collecting the corpus of 50 lakh. And this is a travel fund that she wants to create for herself. And again, she wants some fund suggestions. So this is a very interesting question also, because there's a goal lined up. And in fact, in the first question only, I wanted to ask you that it's nice that these investors are thinking of long term and want to have a long term strategy for their long term financial goals. But then they also have some aspirations. They also have some dreams which they want to fulfill by investment portfolio. Like Ritika, she wants to travel. we don't have her on the phone line, otherwise we could have asked her if 50 lakh is what she's really looking at and what's the time horizon, after which you might want to travel a lot. But then given the fact that you can align your goals, you can plan them, you can start investing for them, be it short, medium or long term, is the beauty of this entire strategy that one might want to adopt.
Sure. So typically, rather than working on a 50 lakh portfolio for travel, I think I'd also like to give a little advice right now is to figure out where you are going. Where is your first holiday? So, you won't be going for an international holiday right in the beginning of your earning career. You might start with a smaller holiday, maybe in India, maybe driving distance from the city that you live in. So, your transport cost will be a little bit lower. Also, where you plan to stay and how you plan to do your sightseeing. A little bit of budgeting now can really help you to start your travel goal immediately. Because 50 lakhs is, frankly speaking, a very large amount of money, which you may not use, the entire amount for travel. Because, I'm assuming that you want to have this corpus and then you want to travel every year to exotic destinations. Rather than that, what you should be looking at is looking at, travel destinations which are closer to you, looking at cheaper options of stay and travel and sightseeing so that you can start your travel journey very comfortably with lower amounts, because at this point you are planning to save about 2,000 rupees. So, you should be also a little realistic in terms of, where and what you can achieve in that much, because the, mutual funds and the investment options will be shorter term, medium term and longer term. For the longer term buckets, you can be invested in a mid-cap portfolio, in a small-cap portfolio, in a multi-cap portfolio, but that will be setting you back by many years. So in the mid-term, which is say between 1 to 3 years or, say 2 to 5 years, that would be, we would consider that a mid-term kind of a scenario where you can be looking at an investment in a balance advantage category or in an equity savings category or in a large cap category of, mutual fund, which will help you to serve your goals. But at this point of time, if you are asking me, I'm investing 2,000 rupees, when will I reach my, goal of 50 lakh rupees? Or the other way around, I have about 10 years to invest. How much money do I need to reach 50 lakhs? So my answer would be you need about, I think 45,000 rupees in SIP in order to reach that goal of 50 lakh rupees, because the goal is only that high. So realign the goal, realign the investable amount, and you are sure to meet your travel plans quite successfully.
Advice for Ritika. We move on to our next query, which is from Rahul, again an email, and Rahul says that he has Parag Parikh Flexi Cap in his portfolio. Nisreen, he has SBI Mid Cap and Access Small Cap, and Canara Robeco Small Cap Fund also, 4,000 rupees each in all these funds, and he wants to do this SIP for 25 years, and 10% step up is also what he's thinking. Currently, he's 33 years old, and he wants you to review his fund mix. So, as per his age, I think funds are really good, but then a little more towards small cap.
Yeah, so he is skewed towards small cap, I think possibly because he's looking at the 27-year investment horizon. Okay, so there again, I would like to just advise him to, because you never know when you need money. You need money for emergency funds. You'll also have shorter term goals. So if this is some funds that you're keeping aside only for the, extended period, which is 27 years away, I do understand. But it's for all, caution, you should be investing at least 30% to 40% of your portfolio for the shorter term investment option. So as I said, as I advised somebody else earlier, in the 0 to 1 year segment, you can look at arbitrage funds or money market and low duration funds. From the 1 to 3 year segment, you can look at balance advantage category. If your risk profile is slightly higher, that means you have a slight more comfort of funds availability, you can look at the large and mid category and the flexi cap category. And for any goal which is 5 years upwards, where you know confidently that you're not going to need the resources, so that could be say 30% of your portfolio. You can put it away for, in a small cap skewed portfolio, which you are doing currently. So do have a look, at the portfolio. It is a very good portfolio. It's a longer term portfolio. So when you're going with a small cap like this and a flexi cap, you are going to be committed for a longer period of time. But, the way things go, sometimes we do need the funds before our expectations. You will have some sort of emergency, you will have some sort of requirement in the shorter term. And at that point of time, if the money is illiquid, if the market has corrected and you're not able to withdraw even your principal amount, you will have a very unsatisfactory customer experience and you will feel, okay, mutual funds are not for me. So to avoid that, keep buckets of investable surpluses for the shorter term, like 0 to 3 years, 3 to 5 years, and then 5 years upwards. So you can make a small change in your portfolio in order to avail this liquidity and give you that flexibility even in the 0 to 5 years category. Okay? If you're investing for this amount and you've managed to get a 15% compounded annualized growth rate for the entire term, you will have a healthy corpus of 9 crores and 75 lakhs. Based on what you have said, that you are investing 16,000 per month, but every year you are going to step it up by 10%, which is also a very, very smart thing to do because we rarely, increase our SIPs. We don't top up our SIPs every year. When you start a figure, then you just continue for 5-6 years without thinking that annually your income is also going to go up. And therefore, with that increase of 10% annually, you are going to spend it if you don't invest it. So do remember that today's savings are tomorrow's spending. And when you are retired, you're going to spend your money. But of course, because you have taken advantage of this step up, which I heartily congratulate you, it's a very, very smart thing that you've done. And, so the step up is very important every year. We must take into account that, hopefully our incomes will be going up marginally by between 5 to 10%. And that extra salary should be immediately put to use in your SIPs and not left idle, forgotten or spent.
Let's move on to our next question, Mrin. It's from Bhaskar and he wants to know the right time to redeem Tata Digital India Fund. So before we give him the answer, I want you to help our viewers understand what kind of a fund is this and what kind of a sector it follows. What's the fund exposure like?
Sure. So the Tata Digital Fund basically is a fund which is, concentrates on technology, on communication, on services, on capital goods, financial sectors. And the main thing is that because it's digital, and right now the 3 main sectors which are poised to do very well, it's a sectoral fund, I must give you that. So it's a higher risk fund because, the stocks that will be selected here, like for example, the top 5 stocks are Tata Consultancy Services, Tech Mahindra, LC, iMindtree, HCL Technologies, Infosys. So these are the stocks which are the top 5 in this particular fund. So definitely it is a sectoral fund and therefore it is a higher risky kind of a, investment option. So since you have clearly taken it, please stay invested because the next 5 years we definitely expect consumer, IT and financials to do very well. So please continue with this investment. Do not redeem it now. You will miss out, on some discovery and some valuations if you redeem it too early. So, having said that, typically we do not suggest our investors to go into sectoral funds unless it is 5 to 10% of your portfolio. So if you have other funds, then it is absolutely okay to restrict any sector, whether it is pharmaceuticals, whether it is infra, whether it is digital or IT, to about 5 to 10% of your portfolio, but it can't compose your entire portfolio. But now that you have invested, please stay invested because you will certainly make some funds here. But you have, as of now, you should stay invested.
Stay invested. That's the word for you. Manish has sent this question via email. He's 42 years old and he has a goal of 5 crores in 18 years. And that's his retirement corpus that he's planned. And he wants to understand what should be his SIP amount and in what kind of funds that can actually get him this 5 crores of corpus after 18 years. So, ideal SIP amount would be, Mrin?
So his SIP amount should be about 45,000 to, around 45,000 rupees for 18 years, provided that we have managed to get a compounded annualized growth rate of 15%. Okay. Since he is looking at a slightly longer term, we can safely say that, we normally predict about 12% for a large cap fund. For a multi-cap fund, we project at the rate of about 13%. And for a small and mid-cap fund, we kind of project at the rate of about 14 to 15%. So having said that, one always has to err on the side of caution. And so we will just take a round figure of about, between 12% to 15%. So the SIP at 15% is about 45,000 rupees. And at 12%, it will be slightly higher, around 52,000.
All right. Could you also explain the kind of funds he should have in his portfolio?
So, 18 years, you can go for a multi-cap strategy and a mid-cap strategy for about 50 to 60% of the portfolio. And for the balance 40%, you can go for a large cap strategy or a large and mid or a flexi cap category. 10% of the portfolio should be for your immediate liquidity return, which can be either a 100% debt option, or it can be an arbitrage fund or an equity savings category. So do not forget to keep about 10% of your portfolio in a slightly liquid option, which is equity savings, balance advantage category. And to be even more safer, you can be in a low duration fund or an ultra short debt fund. Both of these are in the debt category. So 10% in the shorter term bucket, about 30% in a large mid or a flexi, and the balance 50% could be in for the longer term, which is your retirement goal. And it's that you can aim towards keeping either mid, small or multi and thematic. Do a combination of these for the longer term.
Years is a very long time actually. How often should one be reviewing their portfolio?
So typically, Kavita, we review every year, but we make changes every 3 years. Because to churn the portfolio on an annual basis, you will get nowhere. Also, you're not giving the fund manager enough time for performance, especially if you're in a value category or if you're in a small and mid category, which requires time to perform. So the handholding is very important because, investors do get a bit anxious in the 6 months or 1 year stage when they have not seen returns or they are seeing some performance decline, even the principal amount is not, visible. So therefore, the education of the investor is very crucial because there is this beautiful, opportunity called a mid and small category. But for that, you have to be disciplined, you have to walk the talk, and you have to stay invested. So both the advisor, distributor, stroke planner, as well as the investor has to go hand in hand during this journey to make sure that the investor doesn't lose faith earlier. Because if you see a decline in your statement and you see some red, then you feel that I just want to get out of it. But actually, the silver lining could be just 6 months away or 1 year away. So the idea is, for you to build up your resilience and also to stay invested even in the bad times. So, for example, if there is a correction, that means there's a sale. Okay, now what do you do in a normal sale when you want to buy clothes or you want to buy shoes? You go out and buy in the sale. So the same thing happens when there is an opportunity. You have to purchase a little more than your usual SIP and also make sure that the rupee cost averaging works for you. In layman terms, it means when the units are priced low, you are going to purchase more units.
Right.
You should buy more when there's a sale going on. And when the price is down, don't get disheartened because every time the prices go down, it will also, the NAVs will go up at a certain stage.
Exactly.
Okay.
Exactly.
So just stay invested, have the patience, and create a portfolio which works for you personally by keeping some liquidity in hand, even for the shorter term.
Very important. On that note, it's a wrap today. Thank you so much, Nisreen, for being on the show and helping our viewers with their financial portfolio strategies. And I'm going to leave our viewers with our WhatsApp number and email ID where they can send us their portfolio-related queries and we'll get them answered by our experts. Thank you so much for watching. Goodbye.